On May 26, 2026, a single diplomatic signal, a memo circulating about hopes for a U.S.-Iran peace deal, produced one of the most revealing single sessions the Toronto Stock Exchange has seen in over a year. The S&P TSX Composite ended up 1.3%, closing at 34,005. That headline number hides a fracture. The mining sector gained 6.2%, its best single-day performance since April 2025. SSR Mining, America's Gold and Silver, and IAMGOLD each rose between 15.8% and 17%. Gold itself climbed more than 3%. At the same time, the TSX Energy Index fell 4.3%. Vermilion Energy dropped 10.4%. Cenovus Energy fell 4.2% on the same day its own quarterly earnings showed an 83% profit surge year-over-year. One news event, two sectors moving in opposite directions by a combined spread of more than 10 percentage points. That kind of divergence is not noise. It is the market repricing a structural assumption that has been embedded in the TSX for most of 2026. That assumption is the war premium. Since the Iran conflict began feeding higher oil prices into global energy markets, the TSX has benefited directly. Canada's energy sector earnings, including that Cenovus 83% profit figure, were generated in an environment where geopolitical scarcity added a persistent bid to crude prices. When a peace deal, even a hoped-for unconfirmed one, enters the picture, that bid begins to leave. Alan Small, a senior investment advisor, described it precisely. When the war started, it benefited the TSX because oil prices went higher. On May 26, the opposite effect arrived, the same logic running in reverse.
The 6.2% surge in TSX mining stocks on May 26 can look on the surface like a contradiction. If peace is good news, why would gold, a classic safe haven asset, rise more than 3% on peace deal hopes? The answer requires separating the mechanics of gold's relationship to geopolitics from oil's relationship to the same. Oil prices are directly tied to physical supply constraints in the Middle East. When conflict risk rises, oil rises. When peace risk rises, the possibility that sanctions ease, that Iranian supply returns to the market, oil falls. The mechanism is inventory and scarcity. It is direct and linear. Gold is different. Gold rises on uncertainty, but it also rises when real interest rates fall, when the US dollar weakens, and when broad market risk sentiment shifts in ways that redirect capital. On May 26th, the peace deal memo pushed oil down and, through that, weakened petrodollar dynamics enough to support gold's own rally. Capital moving into emerging markets, commodity-linked equities, and miners specifically, lifted the gold complex even as the war scarcity logic faded. What this means practically for TSX investors is that holding energy stocks and holding gold miners in 2026 has not been a diversified position. It has been two expressions of geopolitical risk, priced at different angles. SSR Mining and IAMGOLD rising 15 to 17% in a single session is not the same type of move as an oil stock falling 10%. One reflects a re-rating of the gold price itself. The other reflects the removal of a premium that was always temporary by definition, because it depended on a conflict continuing. The Cenovus energy situation makes this concrete. Its Q1 2026 results are genuinely strong in isolation. Free funds flow up 124.5%, upstream production at a record 972,100 barrels of oil equivalent per day, a 10% dividend increase, and Christina Lake North expansion adding 40,000 barrels per day by 2028. Those are structural operational achievements. But the stock falling 4.2% on the same day those results are publicly known tells the market's view. The price at which those barrels are sold is more important than the volume, and the price is now under a peace deal threat that no amount of operational efficiency can fully offset.
The central question for TSX investors after May 26th is not whether a US-Iran peace deal is good news for the world. It is which portion of the TSX's 2026 performance was earned on fundamentals, and which portion was borrowed from a geopolitical scarcity that may not persist. The energy sector's problem is straightforward. If Iranian crude returns to global markets, the supply picture changes, and the price premium that powered earnings beats across Canadian energy names compresses. The operational records, Cenovus Energy's production volumes, Vermilion Energy's cash flows, remain real. The price environment that multiplied those volumes into exceptional profits may not. Companies with strong balance sheets and low break-even costs will survive a price correction better than those that stretched capital expenditures to match a war price revenue environment. The miner situation is more nuanced. The May 26 surge was large, but single-session moves of 15 to 17% in individual names are also the kind of moves that partially reverse. The underlying gold price rise of more than 3% in one session reflects a genuine shift in sentiment, but gold is also sensitive to what happens next in U.S. monetary policy, in dollar strength, and in whether the peace deal actually materializes into signed agreements and lifted sanctions. SSR Mining and IAMGOLD gained on the expectation of a new global risk environment, but expectations are not certainties, and the path from a circulating memo to a durable peace agreement runs through considerable political complexity. For investors watching the TSX's 8 of 11 sectors in the green on May 26th and concluding that the index is broadly healthy, the more useful observation is this: the composite index rising 1.3% while hiding a 10 percentage point spread between its two most war-sensitive sectors is not a clean signal. It is a market beginning to sort out, in real time, what it actually owns. The TSX benefited from war pricing in 2026 in a way that lifted the whole index. The exit from that pricing will not be uniform, and May 26th was the first session where that unevenness became visible in a single afternoon. If the peace memo advances to a formal agreement and oil holds below the war-era range, the energy index decline of May 26th will look like a preview. If talks stall and the conflict premium returns, Cenovus Energy at a 4.2% discount on record earnings is the test of whether that war price floor was ever a fair value or just borrowed time. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.